Welcome to this explainer on the reality of dividend investing. Today, we're peeling back the curtain on a strategy that is absolutely surrounded by hype and buzzwords. We are going to look past the shiny marketing and separate the fiction from the hard, undeniable data so we can get a really clear view of what this strategy actually does for a portfolio. So let's just start right off the bat by challenging a widely held assumption. Is dividend investing really the safest bet in the stock market? I mean, you see it heavily promoted everywhere as this flawless, foolproof strategy for passive income. But is it truly as flawless as many beginners believe? We need to look closely at the actual mechanics here, because relying on assumptions in the market is a very quick way to lose money. Just to make sure we are all starting from the exact same baseline, the basic premise of dividend investing is buying into stocks and funds for that regular cash payout. You buy and hold the stock, and the company periodically deposits a slice of the profits directly into your account. It sounds like the perfect setup, right? It's incredibly easy to see the allure. Dividend stocks are marketed almost like a magic bullet for low-risk, high-reward returns. But look, to make informed financial choices, we've got to objectively identify both the positives and the hidden negatives. There's literally no such thing as a free lunch in investing. So let's bust some of the biggest myths surrounding this strategy, drawing on some great insights from Tata Capital.
All right, myth number 1, dividend investing is boring because it relies on slow-growing, static companies. Well, actually, that's only true if you exclusively chase high-yield stocks that never move in price. Incorporating low-yield dividend stocks actually makes this strategy incredibly dynamic. Why? Because these low-yield stocks often belong to companies that are still growing aggressively. This means you don't just get a dividend payout, you also get significant capital appreciation as the stock price climbs over time.
Moving on to everybody's favorite topic, taxes. The myth floating around here is that dividends are some massive secret tax loophole. The reality? Not quite. Dividends aren't always the tax haven people think they are. In fact, they are typically taxed at the exact same rate as long-term capital gains. Plus, since dividend stocks sometimes grow slower than non-dividend stocks, your total overall returns might be lower. So the actual net income you walk away with after taxes might sometimes be lower than what you'd get from simply investing in high-growth non-dividend stocks. Myth number 3, and honestly, this one can be really dangerous, is the belief that high-yield stocks are always the best choice. I get the logic. A 10% yield has to be better than a 3% yield, right? Well, not necessarily. It is absolutely crucial to remember that dividends are paid directly from a company's cash flow. The reality is that a massive payout reduces the cash that company has on hand, leaving significantly less money for business growth, research, and expansion. Sometimes a high yield just indicates management literally doesn't see any significant growth potential left for their own business, so they're just handing the cash back. You might be buying into a stagnating company. Which brings us to the absolute biggest myth of all, the idea that dividend investing is a 100% safe and reliable strategy. Even though regular payouts do generally point to strong financial health, they offer absolutely no guarantee of future stability. The reality is that dividend stocks operate within the exact same volatile stock market as everything else. And listen to this, because it's a massive red flag. Sometimes, struggling companies will literally borrow money just to maintain their dividend payouts and keep investors from panicking. No way, right? But it happens. To put that risk into real historical context, just think about the number 70. Remember that even an absolute titan of industry like General Electric was forced to slash its dividends in 2009 due to the massive economic recession. Now, they had paid consistent dividends for 70 years prior to that. 70 years! If a giant with 7 decades of perfect dividend history can be forced to cut payouts, it just proves that no dividend is entirely immune to market forces. And finally, let's talk about building your overall portfolio. The myth is that buying a bunch of different dividend stocks gives you good diversification. But the reality, relying solely on dividends artificially limits your portfolio, totally cutting you off from higher growth, non-dividend opportunities. True diversification requires a deeply balanced mix. Dividend stocks are a great ingredient for sure, but you just can't bake the whole cake with only one item. Safe havens in bear markets. Okay, so we've cleared away a lot of the misconceptions. Now let's look at the objective reality of where dividend strategies actually shine the absolute brightest: economic downturns. According to historical research and data from HDFC Securities, high dividend yield stocks tend to perform noticeably better in bear markets than other stocks. And the reason why makes total sense. It's because of their defensive characteristics. These are usually mature firms with incredibly steady cash flows. Because they're mature, they have fewer reinvestment needs. They don't need to pour billions into new speculative projects. They also tend to sit in defensive sectors, things like utilities or essential consumer goods. Because of this, they weather heightened market volatility far better and provide serious downside protection when your growth stocks are plummeting. To ground this theory in real-world application, let's look at some hard numbers. Diving into curated data from HDFC Securities Analysis, we can identify some of the absolute highest yielding stocks out there. You've got REC Ltd topping the chart with a massive 13.8% yield, followed closely by SAIL at 13.5% and Power Finance Corporation bringing in 12.2%. Seeing it visually, it's pretty striking. These top 3 companies are offering immense yields, well over 12%. And the income potential here is obvious. When the broader market is trading sideways or even dropping, generating an automatic 12 or 13% return purely from cash payouts provides an incredible cushion. That is literally cash in hand, regardless of what the stock ticker price is doing that day. But, and this is a big but, we have to keep our expectations grounded in reality. This quote from the HDFC research really hits the nail on the head. Exposure to dividend-yielding stocks should be considered for generating regular income and downside protection rather than to maximize returns. The true mechanical purpose of these stocks is to provide a shield during hard times and a steady, predictable income stream. They aren't rocket ships designed to beat the market's maximum return during a massive bull run. Think of them as your portfolio's anchor, not its engine. So, how do we actually put all this into practice without falling into a trap? It's all about discipline. Step 1. Always focus on strong underlying business fundamentals over immediate payouts. Step 2. Avoid the amateur mistake of overpaying for stocks right near their ex-dividend dates just to chase a quick one-time payout. And Step 3. Patiently build a diversified mix of both dividend-paying safe havens and non-dividend growth assets. As we wrap up this explainer, I want to leave you with something to really chew on. Take a hard, honest look at your own financial goals. Does your portfolio have the right balance of growth and defensive dividend power to actually weather the next market storm? Make sure your strategy is prepared for the real data and not just the myths.